Good morning and welcome everyone to lucky episode 13 of Mortgage News Live, coming to you from land and town. Thank you as always to our sponsors MPowered, the Intermediary and of course Newspage for their support. We have another very interesting show this morning where we'll be mainly talking about the later life lending market, which has proved to be a complex and perhaps controversial area of the market for some people. In the main mortgage arena, however, there is a sense of an eerie calm descending, perhaps a calm before the storm, as the markets try to make sense of a whole host of global issues. In the US, we saw higher than expected inflation figures. We're hoping that tensions in the Middle East do not increase further. And in the UK, wage growth still appears to be strong, leading up to the next set of inflation figures here. Swap rates have unfortunately ticked up quite a bit, with 5-year money back over 4%. So are we on the cusp of further rises from lenders in the weeks to come? There have been some good changes in criteria from the likes of Santander, Barclays and newcomer Perenna with their long-term fixed rates, whilst the thorny issue of FCA fees has come to the fore once more. An increase in the well-run mortgage industry seems to be inexplicable. But enough of my ridiculous ranting, and over to this week's pious and professional panel of experts who will be discussing the industry as a whole and the place of later life lending within it. Joining us are Holly Hensley from Later Life, who's a later living planner at Later Living Now. I hope I got that right, Holly. Hello,
Morning.
Holly.
It's a bit of a mouthful, isn't it?
That was, yeah, I should have practiced that, shouldn't I? The inimitable Ed Payne, who's a director at Clifton Mortgages. Morning, Ed. And the wonderful Nicola Palmer, who's a key account manager at Livemore Mortgages. Welcome, Nicola.
Oh, morning, everybody. Thanks for having me today.
It's a pleasure. So, before we get into the nitty-gritty of later life lending, how are you all seeing the market, and what are your clients feeling at present? Are they concerned or cautiously optimistic? Holly, let's start with you.
It's a bit of a mixed bag, really. Obviously, all clients are subjective. I am personally finding that there's not much of the lifestyle stuff happening at the moment. So I'm not talking to people about cruises, holidays, home improvements. I'm generally talking to people about paying for care at home, repaying a problematic mortgage, whether that's because it's an interest only that's expired or because they're facing repossession. Repaying debts, sometimes in relation to a business with the aftermath of COVID. So I'm probably 90% of what I'm doing at the moment is necessity stuff as opposed to lifestyle. In terms of clients' view on the market, obviously rates have dipped a little bit from what they have been for the last couple of years. So that's been positive. And to be fair, I've had clients going from application to completion where I've had one client that had 5 rate decreases within that process. So that there's been, the positive element of it, although rates weren't what they were, a couple of years ago. So overall it's looking a little bit brighter, I think.
And what about yourself, Ed?
Yeah, well, I'm very much a generalist, as you know. I do a lot of later life business, but I also deal with first-time buyers. I deal with landlords as well. And I think general sentiment across the market is quite positive. It was very positive at the start of the year. Then interest rates started to go up and it became much more panicky. We were all scrambling to get rates. That's calmed down a bit now. But, I'm very much focused on the West Country market. And around Bristol in particular, I'd say sentiment is very positive, and there's a lot of first-time buyers coming back to the market. I too am having to deal with a lot of necessity-based lending for older clients, but actually I'm seeing a lot of second or third time arounders buying property in their 50s. I've had probably 2 or 3 first-time buyers in their mid-50s in the last month, taking advantage of the fact that products are now available to them that possibly weren't before.
Yeah, it's interesting. And Nicola, from a lender's perspective, how's the first quarter for Livemore in your sector?
Yeah, I think to echo what Holly and Ed have said, really, I think pretty much every lender's probably seen a shift in the lending that they're doing and the reasons that they're lending. So banker mum and dad, a big part of the industry. So people borrowing as either helping kids get on the property ladder or early gifting so that they can see the benefit of that early inheritance and see what it's actually going to be used for. As Holly mentioned, interest-only mortgages coming to an end. I think there's £200 billion of interest-only mortgages that are actually expiring in the next 10 years. So there's a massive sector there for people that are over a certain age that perhaps when they took that interest-only mortgage out, they thought that downsizing would be their way of repaying it. But actually, in reality, they don't want to downsize for whatever reason. They like where they live. They like, the local community that they've got. They like having that extra space for kids and grandkids to come and stay. And actually, they don't want to downsize. So they need a solution. And later life lending is sometimes that correct solution for them.
And is that, Ed, we've heard this term bandied around quite a bit, haven't we? The interest-only time bomb. Is that something you see? Is that just blown up out of proportion, actually? Are people actually probably more aware than the press have us think about that?
No. I think it comes down to the sophistication of the client, to be honest. And I think you've got two sides to it. You've got those, as Nicola was saying, that don't want to downsize or don't want to pay it off and feel perfectly comfortable in making the repayments. Whether that's just because they like having the money in the bank for, their spouse if they pass away, whether it's because they're, we're empty nesters and now all of a sudden the kids have come home to roost and they feel they can't downsize. There's a real mix. But I do see a lot of people that have fundamentally, in my opinion, been missold. Their incomes had no real chance of growing significantly. They were in relatively poor quality housing. They've continued to take out credit with a history of taking out credit in the past, and they've got to their late to mid 60s. And the majority of the time, by the time customers come to me, they've been receiving letters for 1 or 2 years, very often saying you need to repay this, and then they'll turn around at the last minute saying, can you get me a mortgage? And that seems to be the people that come to me. I think more sophisticated ones, or those with more resources to hand, they will repay them. But it's definitely an issue. But one thing I would say on that, Ottie, is these customers are very often paid that mortgage for 30 years. And very often, because of the lack of sophistication, they've paid it on a high SVR for a long time during that period.
That's a really good point.
To help them actually take a cheaper deal and overpay their mortgage. The regulator says there's a real problem here. And all they do is push lenders to write to people and say, you've got to pay this off or we're going to take your house away from you. The advent of RIOs doesn't really help for those clients that, don't have significant pension income. And we've got a regulator saying, on the one hand, it's an interest-only time bomb, but the same regulator saying there's a massive pensions gap. Well, I think you've just identified two problems there. If those customers are paying it, I don't think lenders should be turning around to somebody just because they've turned 70 and say, you can't take this mortgage. Or as I'm often seeing with lenders, we'll let you extend the mortgage, but you need to take it on a repayment basis. And then the payments go massively up just at the same time as their interest rates have gone up. So I think, I don't think the regulator, lenders are scared of doing the wrong thing, but lenders and the regulator need to be more pragmatic, which will mean less business for me. It's money out of my pocket if the lender says, yeah, fine, you can carry on. But ultimately, I shouldn't be needed in some cases.
Yeah. So that's really interesting, actually, in terms of there's that whole education piece around too many borrowers staying on the variable rate. And Holly, you were nodding your head around that. I'm loving your fireplace in the background, by the way.
Thank you.
That looks sensational. Sorry, I'll just do that. Just randomly comment.
I was just going to add, I think a lot of older borrowers of the opinion that perhaps they can't get a mortgage at a certain age. And I think that's where the industry needs to change. And I know it's something that Livermore are really keen to, make people aware that actually just because you're a certain age shouldn't mean that you can't borrow for whatever reason, whether that's your interest only mortgage coming to an end or for an aspirational reason. So I think that's really important. The fact that it is an education around, just because you get to a certain age shouldn't and doesn't mean that you can't actually have a mortgage, whether it's because you might be getting divorced. There's so many more divorces for older couples, and they may not realize that they could both get a property. So I think that is, again, it's all about the education of the industry.
And it's about, Holly, isn't it, not just waiting to educate people when they get to those ages. It's surely they've been paying this for years, even when they're working, maybe.
Yeah, it's catching them beforehand and at the right time, isn't it? And it's who does that responsibility lie with? So a lot of my interest only expired clients, they're on the standard SVR. They moved to interest only because of an income shock, whether that was illness, redundancy, whatever it might be. And then before they know it, the term has run away with them. So, it was 10, 12, 15 years ago when they moved to interest only, which was meant to be a temporary solution. And then before they know it, that 10, 12, 15 years has run away, and they're in a situation now where they've got this big lump sum of money to find. And a lot of my clients are saying, I've got no options, I've got to sell. But I think that the better side of that is that it's pushed the later life mortgage market to a degree where there is that flexibility in the market, there is that security in the plans. 99% of my clients, when I go back to them with a plan, if it is something that is suitable for them, they go, this is amazing. I didn't realize it was this flexible, it was this secure, whatever it might be. So there is an answer to that problem, but we should have caught that problem 10, 12, 15 years ago. But whose responsibility is that? I don't know.
Yeah. Well, I'd say it's a responsibility of all of us, I guess, with lenders, brokers. It's down to all of us to educate people and get better in our education around this subject. I mean, part of the difficulty I've found is actually, how do you define this market? What is later life lending? What does it mean to you guys? It might mean something slightly different to all of you in terms of, I'm 54, for example. I know I only live 34, but I'm 54. And actually, am I on the cusp of that market? Surely 55 is too young to be saying, oh, I'm now later life lending and therefore I need this and this. I don't want to go through that. What does it mean to you guys?
Yeah, I think you're spot on. I think 48% of the adult population is over 50. So if you think, well, just about half the adults in the country fall into that category, their needs are going to be so diverse. And I think if you're working in that industry or that market, you need to have the skill set to be able to offer all of the products to clients. So, or if you're not qualified in certain areas, you need to be partnered up with people that will be able to offer alternative solutions and not be afraid of potentially losing that, to a trusted third party. So a lot of the time customers come to see me, and because of the media, advertising, they think that they need equity release in their mid-late 50s. And a lot of the time, I will talk those customers out of taking equity release by the time you look at compounding and the like. And I think one of the biggest challenges that faces advisors at the moment is making sure that we show, under Consumer Duty, that we've shown all options to clients. So some really good tools out there in the market. Nicola used to work at Air. They brought out their Market Navigator tool, which is like a triaging system, which is relatively basic in terms of some of the numbers it gives you, but it will give you a breakdown of standard equity release or lifetime mortgage and interest roll up compared to a RIO or a term interest only, or compared to a standard repayment mortgage, so that clients can see the effect of compounding. Now that helps the client to understand the ramifications of going down a certain route. It also pushes you towards explaining all of the different options to them. So it forces you to explain what these different things are. But very often you'll find that that customer then takes an alternative route, but they might turn into a lifetime mortgage client in 5, 10, 15. And, you know, we need to be thinking almost like financial advisors and looking not just at the deal that's in front of us, but what's going to happen over the next 10, 15, 20 years with that client. It might not be me, but as long as you can, you know, set them on the path and explain the different options, you know, I think we need to do that. And I think the regulator in particular is going to be looking for that, and rightly so. So making sure that we capture all of that information and that we've got a record of our advice process, I think is incredibly important. So that AIR tool is very good. I'm not on commission, by the way, for AIR. So it's just a useful.
I think that's really important. You know, I did work at AIR until a few months ago. I've now come to Livermore, and Livermore are the only lender in the later life market space that offer all of the 4 sort of lending options for either over 50s or over 55. So we have an equity release product, but we also have a RIO, a standard interest only mortgage, and a C&I product. So we have the ability, as Ed was saying, for a broker to be able to look at all of the different options and have that really, you know, sometimes it's quite a complex discussion around affordability because, as Ed quite rightly said, a lot of people come to a broker and say, I want this product. But actually, the job of the broker is then to challenge that, to sort of say, well, you know, is that right for you? Let's have a look. Can you afford to make payments? And discussing that affordability, which, you know, is really important for the findings of the FCA report, consumer duty, and making sure that, you know, you're getting the right outcome for that client rather than just order taking. So Livermore have a maximum borrowing calculator that helps that as well, can put in the income that somebody has, and you can look at whether certain products are affordable for them. So it is about opening up that discussion about what is going to be the right option, and which of the later life products is going to be best for them.
And is that part of the problem in the market that you said that, you know, you're the only lender who offer all 4? And actually, there are loads of lenders out there who will just offer equity release. And anyone who's ever caught daytime TV, you can't move adverts from lenders on equity release, and you need this, and this will improve your life, and blah blah blah, without really explaining what it actually is and does. Is that a problem? Should more lenders actually just look at their product range and go, well, if we're going to do this properly, we need to offer everything?
And I think that's why Livermore actually brought out the equity release product, because they had the other 3 and then they added to it so that we've got the whole sort of, like, we can cover the whole spectrum. But I think, as Ed said, it is down to the advisor as well to know what's going to be right for the client, and if they're not qualified in one of them, to be comfortable enough to say, well, actually I might need to, you know, refer that on to a colleague.
I think it's hard for lenders to do that as well, Monty, because the majority of lenders in this country, the way they're capitalised, just trying to do an open-ended roll-up product doesn't really work. I mean, most of the people that are working within the lifetime mortgage space are insurers, or, you know, they're funded by insurers, so they're quite happy for things to be following gilts or things to be following their annuity rates and to have this open-ended type of product. Whereas if you turn around to a bank, and as you know, I work for Halifax and Accord Bank of Ireland, it's very difficult from a capital adequacy perspective to then start doing that sort of business. And we have seen a lot of people go into RIO market in terms of building societies, and building societies are, you know, the unsung heroes of the later life sector in many ways. They're getting on with it quietly, they're flexible, they've got a good underwriters who, you know, take a view on things, they'll be flexible around SIP income and all kinds of things. But RIOs haven't really worked, and the main reason for that has tended to be about survivor income. And the reason that I tend to use Livermore a lot of the time is because they take a much more flexible view. So yeah, you're absolutely right, Nicola, you do have all of the products there, but I'm always going to look at who's got the best lifetime, who's got the best rate, who's got the best term interest only. But you guys just seem to be so much more flexible around taking a view on income, around survivorship income, about what you can take. Your term interest only product is fantastic. So all the time, if I can't place a product out a customer elsewhere, I'll be able to go to Livermore because you've got that pragmatic commercial approach.
Yeah.
I'll come back to the product set in a bit, because that is really interesting to me. Holly, in this marketplace, it's the term used is holistic advice, isn't it? That's what everyone talks about. What do you see holistic advice meaning? And if you're in this market, do you need other specialists around you because it can be quite complex, can't it? You have to take into account pensions and stuff like that. How do you navigate all of that?
So as part of our fact find, we cover various different options ultimately, because and I've got to be honest, I'm probably having a slightly different experience to Ed, in that people aren't coming to me asking for equity release. They're coming to me with an issue in the sense of, this is what I need resolving. I don't know how I need how I need it resolving. But what are my options? And residential mortgages is the first thing that we cover off after personal details with a client, to be honest. And I want to point more clients in that direction. I don't personally do them, but I work very closely with various mortgage brokers that do in different specialist areas. But generally what I'm finding is you've got some lenders out there that will go to quite old ages, which is great, but it's that lack of interest only options out there. So, it needs to be on a capital repayment. They're 70, so they can only do till 80, for example, with one particular lender. It's squeezing that debt over 10 years. It's making that monthly payment really high. What I am also finding as well is a lot of nervousness around, what if I have to retire? So, I'm 60 years old now. I'm still working. I want to still work for the next 10, 15 years, but actually, health things are starting to creak. What if I have to retire? And I think what they really like about the lifetime mortgage is, one, it's a fixed interest rate for life. They know that payment isn't going to skyrocket. It may mean that they miss out on decreases, but it also protects them against increases. And, they like the flexibility that they can convert to roll up if they need to. They can pause the payments if they need to, or they're self-employed and their income varies. But most of the time, they're just not meeting the affordability criteria with mortgage lenders or the credit criteria. We have credit adverse clients where it's actually a cheaper interest rate fixed for life on a lifetime mortgage that will allow them to make capital overpayments than it is doing a standard subprime mortgage where, that interest rate is loaded for whatever reason. So
that's really interesting.
It's all about just looking at that bigger picture, isn't it? Putting all the options on the table. And pensions, it's a discussion we have, but clients are very reluctant to eat into their retirement fund. And there's tax implications to that, which you've also got to compare with the interest cost on the lifetime mortgage. But it's bringing everything all in, and we work very closely with other mortgage brokers, other IFAs in relation to pension options, and you've just got to do that for every client, because that's what they deserve. It's, you treat every client as a mystery shopper, not because they might be a mystery shopper, but because that's what they deserve. Is the approach that we take, to be fair.
Very interesting. Ed, is it the same with you around? You have your specialist people around you who can look at all of that kind of stuff.
From an investment and pension perspective, there's a number of IFAs we work with. We always try to pass on at least 2 recommendations. The same is true with regards to tax planners, because there could be implications whenever we go through advice for a later life client, whether it's lifetime mortgage or not. I always do an entitled to report, so we're checking, is this going to affect any access to benefits as well. But on top of that, it's always a great opportunity to make sure that they've got their will sorted out, a power of attorney, that they've done it correctly. And if husband and wife are attorneys to each other, and then one of them needs the benefit of it. Very often that LPA, the other party can't use it for their own benefit. So, you've got to make sure that you're dealing with a trusted third party there, who's not just thinking about things now, but also thinking about the future. I think also, what Holly said, I absolutely triage all my clients. So we start with a repayment or, residential mortgage. We'll work down to a term interest only, a RIO, and then lifetime mortgage. But sometimes a lifetime mortgage is better. The interest rate's lower, or it's guaranteed not to go up. And if you've got clients on fixed income, that can be a real positive thing. In addition to that, many people don't realise that you can service the interest on a lifetime mortgage. And every equity release council member out there is going to allow you to overpay, normally by up to 10% of the balance of the mortgage. And unlike residential mortgages, where it's the balance at outset. So you can pay off 10% each year. Obviously, you've got to factor in the interest on the mortgage as well.
Yeah.
But the biggest issue I've got with lifetime mortgages, because I do have people coming saying, I want one. Sometimes I just can't have one because interest rates have got that much higher. The stress on the roll up means they can't extract as much equity as they used to. And, age is a factor as well. So a lot of the time we just need to look at an alternative in the short term, whether it's a RIO, a tier of standard mortgages. And also Holly mentioned 80. That's the exception, really. The majority of lenders are still pushing 70. But you could go to Family Building Society, would work off up to 95 on a repayment basis. A lot of guys are looking at SIP income and saying, right, well, we'll take 4%. So in other words, if it's 25 years or whatever it be, maybe 30 years. But if you go to some lenders, they'll say, well, they only want to take the mortgage over 10 years, and then they'll take a tenth of the SIP. It's.
I think you're right. The building society sector is really interesting, isn't it? I did a couple of years ago. I did a 25-year interest-only mortgage for a 72-year-old with a building society. Now there was guaranteed income there. So but obviously that's an option.
I'm just doing one with Hanley Economic. I've just done one with family. I've done a mortgage with more. There's so many out there. Just one peeve, actually. It's got nothing to do with later life lending, but what I am going to say is, as a two-man band, and some of these lenders are less than 1% market share, if you don't do a case with them in a year, they remove your access. Now, how am I going to do a case with you in a year if you're a 0.25% market share lender and there's two of us? Okay, so if they could think about that and not just remove it, if there's any lenders online, well, there you go. That's my moan for the day, Monty.
There you go. That's a very tame moan, to be fair.
I was just going to add one thing about Ed saying about, some people can't get a lifetime mortgage. I think the other thing that's a big difference in the lifetime market is, that the properties that lenders will lend on, it is different to a normal residential mortgage. There are things that as a mortgage broker that you wouldn't think would be an issue on a property. You take that to the later life lending market, especially a lifetime mortgage, and it does actually become an issue. So property and the type of property is a big thing for a lifetime mortgage, because of the fact that the lender's only going to get their money back normally when that property is resold. So resaleability is a huge part of that market. And I think that's why, again, it's sometimes a bit challenging with rates, loan to values and property types. So it's finding a lender that is a bit more flexible on their lending criteria as well.
I think sorry.
No, go on, Holly.
Thank you. I think going back to the holistic stuff as well, we're so driven as brokers to just think cost. So, a repayment mortgage overall is always going to be cheaper long term than a lifetime mortgage. But actually, it depends on that client's situation. I had a client a few months ago where she'd got £100,000 interest only mortgage on a £700,000 house. She couldn't really downsize because of the location that she was in. So we weren't in that camp at all. But from her point of view, she didn't have any children, any direct beneficiaries. She qualified for a repayment mortgage, but that was £1,200 a month. Say it was going to eat, I think, a certain percentage of her income. She didn't know when she was going to retire. From a quality of life perspective, why would she implicate her quality of life so much just to qualify for a capital repayment mortgage and overall be better off? So it's taking every client as their situation, I think, as well, rather than just blanketing approach, isn't it?
Yeah, I think that's fair.
I was just going to say, and I think the big thing is the documenting and the evidence of that conversation. And I think that's
correct,
a big thing that, Consumer Duty and the FCA report have brought in massively. It's, yes, you're having that discussion, but it's making sure that discussion is documented, whether that's about the affordability conversation, the different types of products that you've discounted it. It's making sure that there is evidence of that. And also, I think the thing with Consumer Duty, it's making sure that, those later life lending customers have a regular review. I think if you look back a few years, it was just seen as you'd write a lifetime mortgage or a later life mortgage, and that would be it. But now it is going back to those clients and having that regular review and regular discussion with them.
Definitely.
Yeah, and Livermore will pay us a fee for doing an ongoing commission for staying in contact with that client and doing an annual review. Perenna and other guys that are looking at 30-year term mortgages, they're starting to do it automatically after a certain period because they've got potentially a lifetime fixed mortgage there, or 20 or 30 year, or whatever it happens to be. So that's helping us. I mean, we've really been dealing with clients long term. It's a bit of a double-edged sword, because you'll do product transfers, and that's a great thing, and it's nice to be rewarded for that. But at the same time, in a falling interest rate environment where you potentially have to rebook the rate 4 times and you get 0.2%, and the client can do it themselves in 30 seconds, and it's difficult to charge a fee to them, that's a real issue. So I applaud Livermore, guys like Perenna and others that are starting to look at this, because if they want us to be more holistic and deal with people long term, they've got to reward us for it.
Yeah, I totally agree with that. Now, that is a whole other subject, which we will cover again.
If we're talking about lifetime mortgages, it is worth saying that, and that factors into things like higher commission on lifetime mortgages. So they'll say, well, you get 2.5% for this versus 0.5% for a Rio, or 0.4. Yeah, but it's a one hit, that client's gone away, and we do have a business.
So that's an interesting discussion, that, Ed, around all of that, around the prop fees and equity release. Are they too high? I've got some quite strong views around it, but actually it's really interesting and refreshing listening to you and Holly, actually, from a broker perspective, and showing you're obviously what good looks like in the industry from a broker perspective. But the FCA has pointed out that potentially, one of the last reports are too many people who could get mainstream mortgages pointed towards equity release. Is that because people don't have the qualifications or the nous that you two do to actually do the job properly, or are they attracted by too high prop fees, etc., etc.? Is the market? I know the market's in a very different place now to where it was, say, a decade or so ago. But do you still think there's a lot of problems in that industry? Would capping prop fees make a difference there and remove some of the jokers? Or
I think the proc fee conversation, looking from the outside in, I understand why people think that they do. And I personally know of a lot of brokers that have been magpied by that proc fee. They see it and it's sort of like, oh, wow, this is amazing. But actually, it's a bigger piece than that. The aftercare element of this is going on for the rest of the client's lifetime. If you don't rebroke them, I have clients from 12 years ago that contact me and say, I've got a quick question on my overpayments or my early repayment charge or whatever that might be. And obviously, unless you are transacting a rebroke that's worth their while and it is going to be a cost saving to them, you aren't charging a fee for that conversation. You know, you're not, but it is half an hour out of your day. And then obviously the longer that you're transacting in this space, the more and more of a back pipeline that you build in. So actually it is a higher proc fee. And I know of plenty of brokers that have been magpied by the proc fee, tried to do equity release, realized actually, you know, doing it properly, it needs a lot of focus and, you know, a lot of work around the more holistic approach and all that kind of stuff. And they've, you know, dropped it and then started referring back to me again. So it's, you know, it's, I can see why it looks the way that it looks from the outside in, but actually, you know, you've got brokers out there that have underappreciated exactly what's involved and why the proc fee is higher, and yeah, sort of taken a little bit of a 360 turn on it. But yeah, that's my 10 pence worth.
That's really
very often it's comparable to, you know, life commission. I think people will think nothing about the commission that somebody gets on a critical illness case, you know, on an indemnified basis, which can be thousands and thousands of pounds. For me, I think you're absolutely right, Ollie. It's long-term contact. We go back to a client every year. And a lot of the time, I can tell they just want me to go away. And they don't want to tell me that they haven't necessarily paid the interest that year or whatever. But, you know, we offer that contact and we do speak to them. Also, a lot of the clients are relatively small mortgages, you know, so if the fee wasn't higher, we wouldn't be able to justify a lot more time. And, you know, we're doing a lot more, it's higher risk business, you know, there's more risk to us here, not just from them, but also from their family in the future. So there's a lot more work goes into it. For me, a bigger issue is that of percentage fees when it comes to the advice side of things. And I had a client that came to me with wanting to do £1 million equity release. In the end, we did 900,000. It was very complicated. It was tax exile involved, sole owner, all sorts of different things with the property, grade 1 listed. We did the deal for them, but they came to me because they'd been to see a large equity release broker, and the advisor had told them that the fee was going to be £15,000 because they charge 1.5%. And then on top of that, they were going to get somewhere between £25,000 and £35,000 of commission. Whereas actually I didn't charge a fee, but my fee is always flat, 795 on a lifetime realty or anyway. And you know, we'd assess that in terms of the amount of time. It is higher than our residential fee, but there's more goes into it. And you know, under consumer duty, we need to be justifying our fees, and I do think that's something that needs to be looked at. I don't think the majority of brokers do it anymore, but there are definitely some players out there that are, and it should go. There's no work.
Yeah. How have you found consumer duty from a lending perspective in this market, Nicola?
Well, I've as I mentioned at the start, I don't know if I did. I've only been at Livermore for a couple of months, so actually, for me, I think it's just about a lot of the work I did with consumer duty was when I was at Air. But I think from a lender's point of view, it's just making sure that, you know, they're supporting brokers as much as they can with consumer duty, whether that's training, whether it's those types of things. So, you know, I don't think I've had that much to do with the consumer duty side of it because of the fact that I've sort of not been with a lender for a while.
Yeah, and on the product side of things, do you think the products are developing in the right way, or is there a lot more that can be done to really start to help a new generation of borrowers in this area?
Do you know what? I think that the later life lending market is continuing to evolve, and you know, you see that on a sort of weekly, monthly basis as different lenders launch different products within the market. As I mentioned at the start, Livermore are the company that, you know, want to be at the forefront of that sort of development, and you know, the offering different products for brokers and clients. But I think, you know, there's always something changing, and there's always something that's evolving within the different products within the market, whether that's the ability to make higher overpayments or more of a hybrid product coming to the market, or as Ed said, having the ability to have maybe a standard interest only mortgage, or Rio or a lifetime mortgage. So there's so much out there for the client, and I think it will just continue to evolve as, you know, each lender wants to be able to get their bigger share of the market.
And from brokers' perspective, are there products you feel that are missing in the market that should be there?
I think we've seen the hybrid product come out from L&G recently, which is potentially allowing people to take more. So they're going on interest service initially and then guaranteed to roll into lifetime. That's useful for those customers where there's not potentially enough equity in the product and they're still working. We used to see things like guaranteed lifetime mortgage. I was always a little bit skeptical because I wanted to make sure they had access to the best deal when they did move over to a lifetime mortgage at that stage. But you know, that may come back. Guys like Standard Life are talking about offering lower interest rates if people are servicing a proportion of the mortgage. That's come out now. For me, I've started to see some lenders like Beverly, I think, say that, you know, they will look at ignoring survivor income on a Rio if the customer says that they will downsize if in the event that they can't afford it. And I think we need to be giving older clients a bit more credit and allowing them to take responsibility. You know, I mean, if I lost my job or I had to shut my business and I couldn't pay my mortgage, I know I'd have to downsize. Why is it different for an older client? I wouldn't tell two first-time buyers that come in to see me, of your incomes because you might have children, you know. So why do we turn around to people and say, well, if survivor income could go down, it's no problem. Let them take out either an insurance policy or let them, you know, because it's available. You know, it doesn't even have to be a whole of life policy. The standard term can be taken for those clients, or some undertaking that they'll downsize if they can't afford it. You know, I think we need to start giving older borrowers a bit more credence. That's one area, I think. I'd love to see, you know, we're really pushed on lifetime mortgages about not letting the customer borrow too much at outset. And that's something we're constantly questioned on. Why did you say take it all now? Well, I said take it all now because on a fixed rate for life, I know what it's going to be. You know, if I turn around to a customer that could have had all their money at 3.5%, knowing there would be a need for it, and said, now wait, do a drawdown, and then all of a sudden now it's 7%, I wouldn't have given them good advice. Again, you know, and the biggest issue with drawdown, as far as I see it, is we don't know what the interest rate's going to be. Customer takes a drawdown out 3-4 weeks after they've done their main advance, which has happened before to me, and the interest rate's been 0.5% more, even though market rates have come down. Well, why is that? You know, so I think maybe a fixed drawdown facility would be a good option. But again, I understand the funding issues that lenders face on that. But yeah, that's one thing I'd ask for.
What about you, Holly? Any gaps you've seen?
I think it's like anything, isn't it? Everything could always be better. You know, we can always want, and you know, it's balancing that out.
Want. We're brokers.
Exactly. I'll
write down your list of wants, and I'll see what Livermore can do after 2 months in.
We're ready to go. So yeah, you know, it could always be better, and like Ed says, you know, there's the practicalities of the funding streams and you know, all that sort of stuff that goes with it. But from a client's perspective, yeah, absolutely agree. A fixed drawdown scenario, an interest only plan, lifetime mortgage wise, with more flexibility. Generally speaking, at the moment, you miss 3 payments and then you're on roll up. You can do overpayments, but you can't reinstate that interest only direct debit scenario. So, you know, that's the ideal world. But again, how that works behind the scenes, I don't know. I am massively passionate and a huge advocate at the minute for how far the lifetime mortgage space has come just in the 12 years that I've been doing it, but mainly the last 20 years. It offers clients so much, and I think it's not common knowledge. You know, every client that I will go and see will say, oh my god, this is a lot better than what I expected. You know, family and friends, since I've been in this industry, when I came into this industry, there was negative, you know, there was negative things being said. Why are you going to do that? And actually over the years, as they've come to understand what it actually is, and the issue that we'll always have, particularly with equity releases, clients that took out an equity release plan 20 years ago, if they pass away today and it all comes out of the woodwork, what they signed up to, the children become fully aware of what that entails, you know, and what that looks like, that feels current. So these articles that come out in the press at the moment about, you know, the downfalls of equity release, they're outdated because sometimes they're about plans that have been advised on 15, 20 years ago. So it will always have that challenge with equity release. We'll always be living in the past to a certain extent. But no, I think we're in an amazing place. When I look at when I started 12 years ago, you'd got 2 lenders and 2 plans. And it was, you know, it was an easier gig, to be fair.
Yeah.
But in relation to what you could offer clients, it's just amazing now, whether it's flexibility around early repayment, moving, overpayments. I think we're in a fantastic place. And like I say, there's always a way to go, but yeah, I don't want to underestimate how far we've come as an industry.
Yeah. Well, cool. That's very passionate, Holly. I love that.
Was it?
That's what I like to see.
I got a bit overexcited then.
That's brilliant. Brilliant. It's what we love. It's what we love. It's why we do this.
I was just going to add, from a lender point of view, I think, you know, feedback from brokers is really important for a lender, just in terms of what's missing in the market. You know, we can't guarantee that we're going to be able to solve everything, but as a lender, we want to hear the things that you see from your clients that you think, actually, this is the space that we need to fill. So it's really important from a lender point of view to get that feedback, so that we know the things that we can think about for sort of like the future of the products.
Yeah, agree. Thanks for your comment, Ruben. You just said the 1.5% charge. That's what Consumer Duty has removed. So yeah, you're right. If anyone does have any comments, please do let us know. Although 45 minutes.
I know, just like
there
that.
There you go. Just goes, doesn't it? So we're close to the end. So I know it has. From a personal point of view, I've learned more in this last 45 minutes than I think I have in the last 15 years about this market. So thank you. It's brilliant to know that there are good people out there doing the right thing for clients in this market. It's really important that you are the people that regulators and the industry listen to, rather than some of the others who might be doing it wrong. But any final words of wisdom to both brokers and, well, all borrowers alike in this market? Ed, I'll start with you.
Start with the wisest.
I was going to say the oldest.
Yeah, I think, as I said previously, anybody in this sector, anything you do, write it down. Okay, that's the key thing. Make sure that you can evidence your advice, that you've explained all of the options to the clients, and that you're working with trusted third parties that can help if there's certain areas of the journey that you can't help the client with.
Nicola?
I think, as Ed quite rightly said, you know, it's looking at all of those different options. I won't bang on about that Livermore are the only lender that do all of those options. We are. But it's making sure you're doing what's right for your client, regardless of the conversation that they come in with to you saying, actually, we want one of these. It's being confident enough to challenge that, to get to the real sort of the bottom of what they do actually need, and making sure, as Ed said, you document everything that you do. You have that really honest discussion around affordability, and looking at what's the right option for each client on an individual basis.
Holly?
I just think, generally speaking, it can be quite an emotive part of the industry for a lot of people. You know, people within the industry and clients alike. But I think keep an open mind is the main thing in terms of a problem that you've got either as a client or as a broker on behalf of a client, and what that answer could be. And, you know, there might be a few different answers, and later life lending might be one of those. But as I keep saying, it's generally a lot better than what people think. And therefore it's not fair to sort of make an assumption without understanding how it would work for that particular client, because until you've seen that in black and white, And we do offer a free consultation and personalized report to outline what that looks like for that individual client, as most brokers do. So I think even if it's going down that route, just to see what that looks like for a particular situation, because it will look different for different people. So I just think it's, keeping an open mind, really.
Brilliant. And there's one last comment from Gavin, which is a rhetorical question, I think. So we'll ponder this. Yeah. Do you think we can get away from equity release as a generic term? Which I probably agree we should do, because clients don't. It's not just the equity release market. Will the Equity Release Council change their name?
There was a vote on this at the and I don't know if it was when it was said or if people didn't really get it, but the majority of people didn't seem in favour of it. Personally, I think it should change.
Yeah, I agree.
My view.
Yeah,
because it's not even equity release most of the time. It's a lifetime mortgage, you know. Yeah. So, I think it's a bit misleading, but I don't know. There didn't seem to be a huge amount of appetite from the guys at the summit, but I personally think it should change. Yeah.
Well, there you go. On that bombshell, change your name. So I think we're definitely out of time now. So thank you to our guests. Thank you, Holly. Thank you, Ed. Thank you, Nicola. I really enjoyed today. We have started shouting out a Star Broker of the Week at the end of each webinar. So please tag MPowered on your socials when you've seen a broker go above and beyond. And our shout out to a Star Broker of the Week is Josh Bezic from 313 Financial. And Josh, thrilled to be named Star Broker of the Week. His exceptional support in guiding a client through their remortgage saved them over $6,000. He's been described as brilliant and a valuable asset to 313 Financial. Pay rise there, Josh. Congratulations. As far as we're concerned, we're going to be moving to bi-weekly, so there won't be one next week. We will be back the week after. You can catch up on all of these on Spotify, so feel free to listen, stream, and I'm very good if you can't get to sleep. If you have enjoyed it, my name's been Andrew Montlake. If you haven't enjoyed it, I've been Jacob Rees-Mogg. Until next time, have a great week.